Hello dosto, welcome to our channel Kosh Gurukul. Friends, global stock markets are falling, gold price are touching lifetime highs, and the inversion of bond yield curve is signaling a possible global recession in the near future. India, on the contrary, is far from a recession, but the slump in sectors such as capital goods, auto, cement, mining and constructions are more disposed to recession, as these have seen contraction in growth for the past few months. As reports of job losses, slowing demand and the liquidity crisis trickled in the last week, the stock market slipped. To be sure, the Nifty has slipped a little over 10% from its peak closing of 12,041 on 4 June. But the suddenness of the decline has shaken the confidence of many investors. The discomfort is justified and prospects of an economic slowdown are only adding to the fears. In today's video, we will be discussing some measures that will help you tide over difficult times. Don't stop SIPs now. Discontinuing SIPs in a downturn is perhaps the biggest mistake an equity investor can make. It defeats the very purpose of the SIP by denying the investor the opportunity to accumulate more when prices are low. The concerns of investors are understandable. However, a downturn is the time when SIPs actually work to your advantages. It's simple arithmetic. As market turn weak and NAVs of fund go down, every SIP fetches you more units. A few years down the line, when the market recovers, the accumulated unit will translate into a huge amount. Friends, SIP work well in volatile markets. So, sticking with SIPs during lean phases pays off later. Avoid investing in property. Builders and housing finance companies are luring buyers with big discounts and low loan rates. The housing market in top Indian cities has not done too well in the past 1 year. The looming threat of an economic slowdown, the situation is unlikely to improve in the next few quarters. Builders are sitting on a huge inventories which will take a long time to clear. This means investing in property is a no-no for now. If you are looking to buy for an immediate use, go ahead and buy. But if you plan to invest a secondary property, stay away for now. There are better options available which can provide you high returns. This is especially true if you intend to take a loan to buy the property. You will be paying 8 to 9% interest on the loan for an asset that is likely to appreciate by 4 to 5% over the next few years if you are lucky. Only the builder and the lender will gain, which explains why they are so keen to make you loosen your purse strings. Diversify with gold. It is always a good idea to diversify the portfolio to reduce risks. During times of uncertainty, investors tend to flock to the safety of gold. This is evident in the sharp rise in price of gold in recent months. Experts maintain that investors should keep around 10 to 15% of their portfolio in gold. Investors who had taken some gold exposure would have been partly cushioned from the recent slump in the equity market. However, avoid buying physical gold like ornaments or bullion because the making charges eats into the return and issues such as safety, liquidity and purity. When investing in gold, go for financial assets such as gold ETF or gold sovereign bonds. Take medical cover for family. When examining ways to reduce expenses, don't even think of cutting out the health insurance from your budget. Health insurance is a necessity that every family must have to protect them against medical expenses in the case of hospitalization. Health insurance acts as a perfect wealth protector in one's portfolio. In fact, in the uncertain environment, make sure your family has a medical cover apart from the group cover provided by your employer. Formulate debt strategies. The loss of a job can throw your finances into a tizzy if you have big loans to repay. But you can leverage your repayment history and relationship with the lender to extract some concessions. Whether it is a home loan or a car loan, banks typically don't want to repossess assets, and will try to avoid litigation as far as possible. In most cases, they are more than willing to make repayment easy. Approach the lender, provide justifiable reasons, and request for rescheduling before it initiates action on recovery. Don't jump jobs in a hurry. When the job market is looking jittery, it is the best not to be adventurous with your career. A lot of new companies have mushroomed in the past few years, but many of these startups are bleeding heavily and could close down if the economy worsens. If you are planning to switch jobs, do in-depth study before you jump ship. Find out how financially sound the new company is and assess its prospects. In a slowdown, only the market leaders are able to keep their heads above the water. So friends, these are some measures that will help you wave through the upcoming global recession period. Keep things tied up. Do subscribe our channel and hit the bell icon to stay tuned with us for such informative stories. Till then, keep learning and keep earning.